Buy what you know is what Peter taught us, and it's so nice to see you this morning, Peter.
Good to be here.
Hi and welcome to InvestU. Last week, Peter Lynch, known for being one of the best investors in history as manager of the Magellan Fund at Fidelity Investments, made a public appearance for the first time after more than 3 years of silence on the CNBC channel. In addition, this week Treasury Secretary Janet Yellen, together with Federal Reserve Chairman Jerome Powell, have issued a serious warning about a possible default of the entire United States if it is unable to meet its debt obligations in the next month of June, with devastating consequences for the country.
Peter Lynch, during this interview, gave his opinion on this crisis that threatens the economy and the U.S. stock market, which has given its first warnings through the bankruptcy of several banks, the most recent this week. In addition, he explained how we should act in this situation, and also revealed 2 great stocks in which he expressed his regret for not having invested a few years ago. But why should we pay attention to the words of this investor? Just listen to the following.
From 1977 to 1990, he managed the Magellan Fund, growing it from, you ready for this, $20 million to $14 billion in 1990.
Yes, this investor was able to transform $20 million into more than $14 billion during the years in which he worked as a professional manager, where he achieved average annual returns of 30%. So let's analyze in detail what he said in this interview, and at the end of the video we will analyze briefly these 2 investments that Peter Lynch regrets not having made.
Don't forget that the best way to support our channel and the InvestU team is to subscribe to this channel. In today's video we will raffle a copy of one of the best known books of this investor. Later we will explain how you can participate in. So let's not wait any longer and go for it.
As you know, since the end of 2022, the U.S. economy and stock market have been under high stress, with very high inflation, significant falls in the main stock markets, and the most aggressive interest rate hike in the last 40 years, causing a great instability in the banking sector. Moreover, last Tuesday, Janet Yellen, Jerome Powell, and Joe Biden himself warned that the U.S. government and its entire economy are at risk of not being able to meet its full financial obligations as soon as June 1st if Congress does not raise or suspend the debt ceiling. This could send the U.S. into full default in less than a month and cause an unprecedented recession. Let's see what Peter Lynch has to say about this more than possible recession.
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. You know, I never know when we're going to go. I'd love to know the future. I think it would help. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. Right. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
As you can see, and unlike the more negative opinions of other investors that we have seen during the last few weeks in the channel, Peter Lynch faces the next recession with a more positive tone, remembering something as simple as that although he cannot predict exactly what will happen, historically after every recession in the stock market, there has always been a subsequent recovery.
And this is absolutely true. If we look at the historical chart of the S&P 500, it has multiplied by 24 times in the last 40 years. With a clear long-term bullish trend despite having suffered numerous economic crises, debt national problems, or stock bubbles, with falls of more than 30, 40, and even 50% in some periods of maximum panic for investors.
This super investor is known for knowing how to accept and use the usual market volatility to his favor. Peter Lynch has stated on several occasions that he loves volatility and is very clear that every few years a recession will hit the markets and that those are the best times to buy his favorite companies at a price discount. This is what he said in an interview in 1994.
So volatility will occur, markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.
Before we get to those 2 companies that Peter Lynch mentioned in his recent remarks, let's take a look at his views on the current banking sector, where after the recent bankruptcy of Silicon Valley Bank, Attention has been focused on First Republic Bank, with its shares plunging in recent weeks, and the final JP Morgan's acquisition of the bank, amid fears of a financial crisis like the one experienced in 2008.
Now the bank's being much more careful. So now we have stress tests. I think the banking system has improved. There'll be some companies go under. That's the nature of it. You know, it's nothing like, imagine 1980, 81, we had double-digit inflation, double-digit unemployment, and people worried the Japanese were going to take over the world. I mean, we were hopeless. I mean, you know, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was, you know, somebody didn't bring up something to worry about.
As you can see, Peter Lynch affirms that the current situation is not so bad and believes that the current financial system has improved and is more resilient than in previous crises. The investor puts the current economic situation in context by comparing it with the situation of the American economy that he himself experienced during the crisis of 1981.
During that period, inflation was over 10%. The unemployment rate climbed to 10.8%, which turned out to be the highest unemployment rate reached at that time since World War II. Today, this figure is 3 times lower. In other hand, interest rates at that time were above 20%, something totally unthinkable today, with interest rates standing at over 5%. In today's video, we are going to raffle a copy of the book One Up on Wall Street by Peter Lynch, one of the best investment and finance books of the last century. If you wanted to participate in the raffle, you just have to leave a comment in this video, like the video, and subscribe to the channel. It is important that you meet all these requirements to participate in the raffle. In the next 72 hours, we will announce the winner randomly in the comments of this video.
The investor continued with his statement, saying that in the stock markets and economy, people always tend to be worried about something, and that the only time he would really worry would be when no one was worried about anything. The super investor highlighted first and foremost the importance of knowing what you own, studying companies before investing in them, investing in companies with competitive advantages and at attractive prices, without worrying too much about the macroeconomic situation. He also added the following advice.
And look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt and no cash. Which one are you going to buy? I mean, that's not too hard to do.
As you can see, and especially in times like the one we are currently in, where it is possible that we may be entering a recession, Peter Lynch says that it is key to invest in companies with solid balance sheets. If we try to find an example from the investor's statements, we can see how a company like Microsoft has more than $26 billion of cash on its balance sheet and about another $79 billion in investments easily convertible to cash. If we look at its liabilities, the company has $6 billion of short-term debt and almost $42 billion of long-term debt. If we now look at a company like Carnival, one of the world's leading cruise operators, it has about $5.5 billion of cash on its balance sheet. If we look at its liabilities, the company has $2 billion of short-term debt and almost $32.6 billion of long-term debt. So, in the face of a major crisis, Carnival would be more likely to be in financial trouble than Microsoft due to having a weak balance sheet. In the worst-case scenario, being at risk of bankruptcy and not being able to meet its debt obligations.
Let's now move on to discover which 2 companies Peter Lynch mentioned during this interview and admitted to having made a big mistake by not looking at them a few years ago, as they would have been 2 fantastic investments. The first company Lynch mentioned is NVIDIA, the world's leading designer of graphics processing units for computers and mobile devices. This company's technology is present in a multitude of sectors such as semiconductors, gaming, automobiles, 3D design, robotics, artificial intelligence, and data centers.
If we look at how the company has evolved over the last 10 years, we can see how the company's sales have grown at an incredible rate of 20.4% per year, and it has been able to go from having a net profit of $562 million in 2013 to over $4.3 billion in 2023. The company has plenty of tailwinds to increase its sales and profits in the future, thanks to being present in some of the sectors with the most expected growth in the coming years, such as cloud computing and artificial intelligence.
However, the investor said that one of his biggest mistakes as an investor was not realizing the quality of a business like Apple. Something that another great investor like Warren Buffett, who is currently the largest shareholder of the company, was able to do.
But he bought Apple. Apple was not that hard to understand. I mean, how dumb was I? My daughters bought us an iPod, for I think $250. I think they're making a $200 profit on that for my music, and they're making only $50 on their computers, not doing very well. But they had a nice balance sheet, and I should have done some work in Apple.
Apple is a company known all over the world today. The company's shares have multiplied by more than 9 times in the last 10 years. If we look at how the business has evolved, we can see how since 2012, the company's sales have grown at a rate of 9.6% per year. A very good growth rate considering that Apple is a giant company of more than $2.7 trillion in capitalization. On the other hand, Apple has been able to go from having earnings per share of $1.58 in 2012 to earning per share of $6.11 in 2022, thanks to a good earnings growth and a continuous share buyback by the company's management team.
Don't forget to participate in the raffle for a copy of Peter Lynch's best book. And don't forget to hit the like button and subscribe to the channel to not miss the next videos. Greetings and good investments.